Welcome to This Explainer. Today, we're going to totally dissect the daily mechanics of the stock market. From the outside, looking at those endless data streams and flashing tickers, it can honestly look like absolute chaos. But the crazy thing is, at its core, this whole system operates on a really logical set of principles. So let's dive right in and uncover exactly what's driving those minute-by-minute price changes for corporate giants like Apple, Microsoft, and Tesla. And that brings us to the central question we're tackling today. Why do stock prices surge one day and absolutely plummet the next? We've all seen those flashing red and green numbers, right? Up 2% on Tuesday, down 3% on Wednesday. It looks totally erratic, but I promise you, there is a distinct, powerful engine actually driving these daily valuations. So instead of just viewing these daily fluctuations as random market noise, we're going to break down the actual mechanics behind them. By the time we wrap up this analysis, those wild, volatile numbers, they're going to make perfect sense. Not as random chaos, but as a fascinating, real-time reflection of global supply and demand. Moving to Section 1, the core engine, the ultimate rule of the market. Okay, so at its absolute core, daily stock price movement is basically a massive real-time tug-of-war. Think about it. When demand outpaces supply, like when a huge flood of buyers suddenly enters the market, prices naturally push higher because investors are willing to pay a premium to get in. On the flip side, when supply completely overwhelms the market with way more sellers than buyers, well, the asking price just has to drop to offload those shares. Literally every single tick you see on a stock chart fundamentally comes down to this exact balancing act. Which brings us to Section 2, the disruptors. What actually shifts that supply and demand? Well, there are four primary disruptors that are constantly shifting this balance. First up, company performance. Say a company drops a record earnings report. Boom, that instantly creates a massive surge of eager buyers. Second is macroeconomic news. Things like shifts in inflation or unemployment totally alter the broader market mood. Third, we've got interest rates, which dictate the actual cost of capital and directly impact corporate growth strategies. And finally, just pure investor confidence, basically how optimistic the market feels on any given Tuesday. A sudden shift in literally any of these four variables will instantly tip the daily scales. Let's step back a bit for Section 3, the foundation. What are we actually trading here? To really wrap our heads around those daily swings, we have to remember what the underlying asset actually is. A share isn't just some digital betting chip you play with on your phone. It's fractional ownership of a real operating business. When you buy in, you are literally purchasing a claim on that company's current assets and its future earnings. And that right there is exactly what the market is constantly reevaluating. Here's how it plays out. When a company needs a bunch of capital to, say, scale up operations or fund some major R&D, they often bypass taking out traditional bank loans. Instead, they raise those funds by issuing shares to the public. Through this process of going public, the company gets the vital cash it needs to grow, and the public market gets tradable equity. This is a whole mechanism that establishes that initial supply of shares we see actively traded every single day. Now, why buy these shares? Well, shareholders are primarily chasing returns through two main avenues. The first is capital growth. That's just the appreciation of the share price over time as the company's valuation goes up, like buying a share for $100 and selling it later for $150. The second avenue is dividend yield. This is where more established, cash-rich companies actually distribute a chunk of their earnings straight into the pockets of their shareholders. These are the two biggest incentives keeping investors so fiercely active in the market. And it's this exact, relentless pursuit of capital growth and dividend yields that actually acts as the daily fuel for our market engine. Investors are continuously reevaluating these companies based on their ability to deliver those specific returns. As expectations shift day by day, or really minute by minute, all those buy and sell orders come flooding in, driving the constant, seemingly crazy price fluctuations we watch on the ticker. That brings us to Section 4, navigating the risks, the reality of the market. Here's the thing we have to acknowledge. The very volatility that allows for rapid wealth creation, that is exactly what creates so much market risk. Capital flows incredibly efficiently, but it's also pretty ruthless. While rapid upward momentum creates amazing profits on one side of the trade, sharp market corrections can trigger severe losses on the other the very second supply starts outpacing demand. Because of this daily unpredictability, successfully navigating the market means you really have to look right past that immediate chaos. Smart investing relies heavily on deep research, solid patience, and long-term planning, rather than just knee-jerk emotional reactions. Believe me, it's so easy to panic sell during a scary dip or to buy at the absolute top during a euphoric rally. But learning to separate daily, noisy volatility from long-term business fundamentals, that is absolutely the key. Truly understanding this underlying engine is your crucial first step to becoming a much sharper investor. So, I want you to consider this. How are you going to react the next time you see the market take a sudden dive? Instead of just seeing it as unpredictable, scary chaos, try to recognize it for what it actually is. Just the scales of supply and demand temporarily shifting under the weight of changing news, fresh performance data, or even just market sentiment. Keep that perspective in mind. Thanks so much for joining me on this explainer, and I'll catch you next time.